Welcome back to the deep dive. We're jumping straight into today's Bitcoin intelligence briefing. And, the market right now, it's just defined by this real tension.
Yeah, definitely.
On one hand, you've got this technical recovery that feels, well, pretty fragile, trying to hold on. But then on the other side, you've got these huge, fundamentally bullish catalysts just stacking up. It's quite the contrast.
It really is. Classic market crossroads stuff. And our job today is, to try and cut through that daily noise, find the signal.
Right.
So we're going to look at that tentative rebound above $110,000, see how stable it really is.
Okay.
And crucially, we need to dissect two massive institutional game changers. There's that historic UK regulatory shift, plus some fresh institutional sentiment data.
Huge news there.
And then we'll tie that back to what the on-chain data is showing, which seems to confirm this structural transfer of wealth that's happening.
Okay, and I think if there's one key thing, sort of the core insight for you listening today, it's probably this contrast, right? You've got the short-term pain, the capitulation, people selling at a loss, especially recent buyers.
The weak hands folding.
Yeah, but that very selling is creating the supply that's being snapped up, pretty eagerly, actually, by more convicted long-term players.
That's the transfer. That's the core story underneath all the daily chop right now.
All right, so let's start with the immediate price action then. Bitcoin did manage a decent rally last 24 hours.
Yeah, so about 3, maybe 4%.
And crucially, it got back above that $110,000 psychological level. It was stuck below there for, 4 days?
Felt like longer. Yeah, 4 days it was suppressed. So this feels like a bit of relief.
It does feel like relief, but what specifically is, giving us this breather?
Well, it looks like a combo platter, really. You've got slightly better global macro conditions kind of setting the stage.
Okay, like what?
Well, risk appetite got a bit of a boost from, the easing U.S.-China trade tensions chatter.
Ah, right.
And maybe more importantly for liquidity, you've got traders now pricing in an almost certain Fed rate cut next meeting, like 98.9% probability priced in.
Wow, okay. That's pretty much baked in then. And that helps risk assets across the board.
Exactly. It just improves the overall environment.
Yeah.
So those are kind of the supportive background factors.
But the move itself, the acceleration upwards, it felt pretty sharp. More than just general optimism, maybe.
Oh, yeah. That was pure mechanics kicking in.
Yeah.
Rocket fuel, like you said.
That happened.
We saw a big chunk, over $300 million, in short positions get liquidated. Forced liquidations.
Ouch. So the bears got squeezed.
Hard. And when they get wiped out, they have to buy Bitcoin back to cover their positions. That just pours gasoline on the fire, accelerates the price up dramatically.
Got it. So a short-term mechanical pump. Creates some positive momentum, sure, but doesn't necessarily mean the underlying technical issues are solved.
Precisely. It clears the decks short-term, but doesn't fix the structure overnight.
That makes sense. So we got the pop, but now we're back to the technical battlefield. For traders watching closely, what are the really key levels, the lines in the sand that tell us if this bounce has real legs?
Okay, yeah, let's define those clearly. The single most critical support level, the one that absolutely must hold now, is $107,000.
107K. Why that specific level?
It's interesting because it's not just a random number. It's where strong horizontal support lines up with the 200-day moving average, which a lot of people watch. It's a confluence.
Okay, so multiple technical reasons pointing to 107K.
Exactly. And if we fail to hold that level, if price breaks down below $107,000, that's a major red flag. It really opens the door for a quick slide back towards $100,000.
Right, that's the critical defense line. What about looking up? Where's the immediate resistance, the first hurdle the bulls need to clear?
The immediate zone is roughly $111,000, up to about $112,700. Getting a clean, decisive break above that range would be the first confirmation that this nascent bullish momentum is actually taking hold.
Okay, 111 to $112.07. And if we manage that, what's the next big test?
Then the focus shifts to a more significant cluster, both psychologically and technically. That's the $115,000 to $116,000 zone.
Ah, the 115K level again?
Yeah, reclaiming $115,000, getting firmly above it. That's really the key technical step needed to properly invalidate this whole recent bearish trend.
Okay, so a lot of technical levels in play. Given all this back and forth, this whiplash, where's sentiment sitting now? Did that short squeeze flip the fear and greed index back towards, greed?
Not quite yet. But the acute panic, the extreme fear we saw last week when the index was down in the 20s, that seems to have subsided.
Where is it now?
It's climbed up to 30 out of 100.
Yeah.
So still firmly in the fear category, but off the floor.
Okay. That's actually an important observation, right?
It really is. The market's still fearful, but it's showing signs of recovery.
Yeah.
And historically, that kind of environment, fearful but stabilizing, that's often prime time for strategic investors.
The ones who buy low ignore the noise.
Exactly. They start accumulating supply from the folks who got shaken out or are just tired of the volatility.
Right. And speaking of strategic investors, if we zoom out from the daily chart battles, the bigger fundamental picture is where the really strategic money seems to be making moves. Let's pivot to that institutional front because, wow, that news out of the UK, that feels genuinely historic.
It absolutely is a truly foundational shift, I think, for global adoption.
Yeah.
The UK's regulator, the FCA,
The Financial Conduct Authority.
right, they've lifted their 4-year-old ban on UK retail investors accessing crypto ETPs, exchange-traded products.
And this means regular investors can use things like ISAs and SIPPs, their tax-advantaged accounts.
Precisely. Individual savings accounts, self-invested personal pensions, these are the main ways people in the UK save for the long term for retirement. And now they can allocate directly to Bitcoin and Ethereum ETPs through those familiar wrappers.
That is huge. That's unlocking potentially vast pools of traditional long-term capital. But the response, it wasn't just, okay, ETPs are allowed now. It was like an explosion on the London Stock Exchange, right? An instant fee war.
Instantaneous and brutal. All the big global players jumped in immediately. BlackRock, Bitwise, 21 shares, Wisdom Tree listing physically backed ETPs.
Physically backed, okay.
Yeah. But the really striking thing was the pricing. Bitwise, for example, launched its core Bitcoin ETP with a total expense ratio, the TER, of just 0.05% for the first 6 months.
Wait, 0.05%? That's practically free.
It's incredibly aggressive. BlackRock came in at 0.15%, which itself was waved down from 0.25%.
How do you even make money at 0.05%? Is this just a land grab? And does this immediately put pressure on fees everywhere else, like in the U.S. market?
It absolutely does, and that's the really powerful insight here, I think. Connect the dots. The UK market essentially skipped the entire early days phase.
What do you mean?
Usually when a new market opens up, issuers start with higher fees, test the waters, see what the demand is.
Right, like we saw initially in the U.S.
Exactly. But the UK, they jumped straight into a hyper-competitive, mature market fee structure on day one. It took the U.S. spot ETFs months of fierce competition to drive fees down this low.
So the UK just leapfrogged that whole process.
Completely. They've set this incredibly competitive global benchmark right from the start. It lowers the barrier to entry instantly and massively accelerates the adoption curve there.
That's a huge institutional tailwind. And it seems to be reinforced by that new Coinbase institutional report, the Navigating Uncertainty one. What did that find?
Yeah, that report adds more fuel to the fire. The headline finding is pretty bullish. A clear majority, 67% of the institutions they surveyed, expect Bitcoin's price to actually rise over the next 3 to 6 months.
67%. That's a strong consensus. What reasons did they give?
Pretty sound ones. They cited resilient liquidity in the market, the supportive regulatory dynamics like the UK news we just talked about, and again, those ongoing expectations of Fed rate cuts helping asset prices.
Okay, so this really highlights that conviction gap we mentioned earlier, doesn't it?
It really does.
You've got sophisticated institutional capital, largely bullish on the medium term.
While the public sentiment gauge, the fear and greed index, is still stuck down at 30 in fear, it's a clear divergence. The seasoned money sees opportunity here, while maybe retail is still nursing wounds from the correction.
But the institutions aren't just blindly bullish, are they?
No, not at all, and that's important. They're pragmatic. The same survey noted that almost half, 45%, believe the market is actually in the late stages of the current bull run.
Okay, so they see upside, but they're also aware of where we might be in the cycle.
Exactly. They recognize the opportunity that arises when prices are depressed due to short-term fear, but they're not throwing caution to the wind. It's calculated, strategic accumulation.
And we're seeing tangible evidence of that accumulation, right? Like with corporate treasuries.
Definitely. MicroStrategy, Strategy as they're known now, they just bought the dip again, added another 168 BTC for about $18.8 million. It confirms their long-running strategy.
They just keep stacking.
Pretty much. And it's broadening out. You also see other companies like Juicy Holdings making strategic moves. They partnered with BitFi to pivot towards being a Bitcoin financial services provider.
Getting access to BitFi's asset pool.
Yeah, which is significant, like $2.75 billion in assets.
Yeah.
So it's not just buying Bitcoin for the balance sheet. It's corporates actively reshaping their business models to integrate with this ecosystem.
Okay, so strong institutional conviction, strategic accumulation happening. Let's shift focus now and look under the hood at the on-chain data. What does Glassnode analysis tell us about the mechanics of this great transfer of wealth?
Well, the divergence on-chain is pretty stark and supports that narrative. What we're seeing is that mid-sized wallets, think holders with between 1 and maybe 1,000 BTC, they're showing consistently strong accumulation patterns.
So the strong hands or maybe committed larger retail and smaller funds.
Kind of that cohort, yeah. They're actively buying this dip. At the same time, the rate of selling or distribution by the very largest holders, the whales, over 1,000 BTC that is noticeably slowed down.
Okay, so the strong hands are buying, whales aren't selling as much. Where's the supply coming from then? Who is selling?
It's coming directly from the more recent, less convicted buyers, the panic sellers, and we can actually confirm this using a specific metric.
Which one?
It's called the short-term holder spent output profit ratio, or STH-SOPR for short.
Okay, STH-SOPR. What does that tell us?
Basically, it tracks whether short-term holders, defined usually as those who've held coins for less than 155 days, are selling at a profit or a loss when they move their coins.
And where is it now?
It has fallen below the key level of 1.
Below 1. And that means...
A reading below 1 means that, on average, these recent buyers are selling their Bitcoin for less than they paid for it. They're selling at a loss.
So that's the textbook definition of capitulation.
Exactly. It's the definitive signal of emotional selling, driven by fear or forced liquidation. And historically, periods where STH-SOPR is below 1 have been prime accumulation zones for patient, long-term investors who can stomach the volatility.
Okay, that ties the whole picture together nicely. Weak hands selling at a loss, strong hands buying the dip. Is there anything else in the ecosystem data supporting this idea of money moving into position?
Yeah, actually, there was a pretty significant macro liquidity signal over on the Ethereum network, interestingly.
Oh, what happened there?
In just the last 24 hours, the Ethereum network recorded almost $1 billion in stablecoin inflows. The exact number was like $995.8 million.
Nearly $1 billion in stablecoins flowing onto Ethereum in one day.
Yeah, that's a massive amount. And large stablecoin inflows like that are often seen as a leading indicator. Meaning that a large pool of capital is moving onto the blockchain, essentially staging itself, getting ready to be deployed into the digital asset ecosystem.
So dry powder getting ready. Whether it goes into Bitcoin or ETH or something else, it suggests significant buying pressure could be building.
That's the interpretation, yeah. It suggests renewed, potentially massive buying interest is lining up.
Okay, let's shift gears quickly to the regulatory and macro watch list. There's this developing story, kind of a political risk angle now.
Yeah, adds a layer of uncertainty, definitely in the short term. It's about that anonymous trader, the one who allegedly made big profits shorting Bitcoin right before that unexpected tariff announcement.
Right, that story's been bubbling up. What's the latest?
Well, it's escalating politically. We now have prominent lawmakers, Senator Elizabeth Warren specifically, publicly calling for the SEC to launch a formal investigation.
An SEC investigation into potential insider trading.
That's what's being called for. Now, regardless of where an investigation might lead, or if one even happens, just the call for it and the potential headline risk.
Yeah.
It introduces political scrutiny for the whole sector. Something to watch.
Definitely. And meanwhile, just on the broader macro front, the market's kind of holding its breath for some key economic data this week, right?
Yeah, absolutely. Events that could sway overall risk sentiment. The big one is still the delayed U.S. Consumer Price Index, CPI report. That's now scheduled for Friday. Inflation data is always critical.
Always moves markets. Anything else?
And then just for general risk appetite, we've got major tech earnings this week. Netflix, Tesla, Amazon.
Lioness.
Yeah. How they report and guide will be a big barometer for the health of the tech sector and, global risk sentiment overall. If they disappoint, that could easily drag crypto down too, regardless of Bitcoin's own fundamentals.
Okay, so pulling all these threads together, the fragile technicals, the strong fundamentals, the regulatory news, the on-chain story, the macro risks, what does this current crossroads demand from you, the listener? How should you be thinking about this?
Well, I think it really demands a sort of bifurcated approach right now because the market itself is split. You've got tactical fragility versus fundamental strength playing out.
Okay, so two mindsets almost.
Kind of. For anyone focused on the short term, the tactical trader, risk management is absolutely paramount. Job number one is watching that mandatory defense line we talked about, the $107,000 support zone. Holding that is key.
But for the longer term, strategic investor.
For them, the narrative looks quite different. Yes, the price is depressed because of short-term fear and technical weakness. But underneath that, we now have these massive, new, bullish catalysts firing up.
Like the UK access at rock bottom fees.
Exactly. And that confirmed high level of institutional conviction we saw in the Coinbase survey. That's why the on-chain data shows the strong hand stepping in.
So for the strategic allocator, this fear is actually the opportunity.
Historically, these periods of disconnect where fundamentals improve while price lags due to fear have been very compelling opportunities for strategic long-term allocation.
Okay, so how does this tension resolve itself in the near term? What are the key signals to watch over the next, say, 24 to 48 hours?
I think there are two main things that will give us clarity pretty quickly.
All right, number one.
Number one is simply price action. Does the market successfully defend $107,000 on a closing basis? That dictates the immediate technical trend. Failure there is bearish short term. A strong hold is constructive.
And number two?
Number two will be the data. Tomorrow, we should get the first release of the U.S. spot ETF flow data covering Monday's trading activity.
Ah, the first look at institutional appetite after this recent correction.
Exactly. It's the official referendum. Did institutions buy the dip via the ETFs or did they pull back? That flow data will be really telling.
Okay, defend 107K and watch those ETF flows.
Got it.
Finally, maybe leave us with a provocative thought to chew on.
Yeah, I think it comes back to that UK ETP launch. Just take a second to really absorb the implications of them skipping straight to a near zero fee, hyper-competitive structure from day one.
It is pretty wild.
It sets an unprecedented global standard. So the question is, what does this mean long-term for fee competition and investor access in every other regulated market around the world, including the U.S.?
Will everyone else be forced to follow suit much faster than expected?
That sudden acceleration of market maturity, driven by the UK's approach, it's a massive global story that's really only just beginning. Its ripple effects could be profound.